In September 2008, the floor of the New York Stock Exchange looked like a disaster zone. Paper debris piled up between trading desks as brokers watched billions of dollars simply vaporize. The panic quickly breached Manhattan. Within hours, automated sell-offs triggered across London, Frankfurt, and Tokyo. The invisible pipelines of global credit, the mechanisms that allow banks to lend to one another overnight, froze solid. The immediate toll was stark. $11 trillion of American net worth evaporated, and 30 million people worldwide suddenly found themselves out of a job. How does a slump in localized American suburban housing markets threaten to shut down the entire global financial engine? This wasn't a random accident. It was the result of an unregulated system operating on a foundation that could no longer support its own weight. Throughout the early 2000s, investors felt remarkably secure. Low interest rates made borrowing cheap, and climbing home prices created an atmosphere where real estate seemed to guarantee a return. This chart shows the macro root cause of the crisis. Deliberate policy shifts suppressed median wage growth to maximize corporate profits. To maintain demand, the system encouraged working families to mask their stagnant incomes with high-interest credit cards, auto loans, and subprime mortgages. Wall Street needed a way to process these high-risk subprime loans. They built collateralized debt obligations, or CDOs. By bundling thousands of unreliable mortgages together and passing them through complex equations, investment banks obscured the underlying risk, securing a pristine AAA safety rating. This graphic breaks down the mechanics. Thanks to sweeping deregulation, European and U.S. banks were legally permitted to use extreme leverage. Many borrowed up to $40 for every single dollar of actual capital they held, pouring all of it into toxic assets. The global economy was now balanced on a precarious bet that families with stagnant wages could continue to service a mountain of growing debt. The breaking point arrived in suburban communities like Stockton, California. For years, buyers flipped houses to escape predatory loans, assuming the market would always rise. Then, the perpetual upward motion of real estate prices stopped. This flowchart tracks the sequence of failure. Adjustable rate mortgages, artificially set near 2%, reset to massive interest rates. Subprime borrowers defaulted in droves. As the underlying home loans went unpaid, the trusted mathematical models on Wall Street, the equations that guaranteed the safety of those AAA-rated CDOs, instantly broke down. A handful of contrarian investors, like Dr. Michael Burry, looked closely at the actual loans and spotted the flaw. They quietly purchased credit default swaps, placing multi-billion-dollar bets that the American housing market would collapse. While these few outsiders realized the system was toxic, the major ratings agencies, regulators, and the broader market remained blindly confident. That confidence vanished when the crisis leaped from individual homeowners to massive institutions. The investment banks hoarding these toxic assets began to rapidly bleed cash. This timeline illustrates the cascading failure, starting with the first major domino in March 2008. Bear Stearns ran out of capital and was brokered to J.P. Morgan in a desperate fire sale. Paranoia consumed Wall Street. Banks realized their competitors' balance sheets were loaded with worthless mortgages, but no one knew exactly who held what. Trust vanished, and institutions completely stopped lending money to one another. The climax of systemic risk hit in September 2008. Lehman Brothers, an institution that had survived for over a century, filed for bankruptcy, sending immense shockwaves of panic through global markets. 2 days later, AIG buckled. The world's largest insurer had written billions of dollars in credit default swaps against the toxic mortgages, but lacked the cash to pay them out. The U.S. government was forced to step in with a massive takeover. Behind closed doors, government officials like Federal Reserve Chairman Ben Bernanke faced a terrifying reality. The commercial paper market, the short-term loans that companies use to meet daily payroll, was dying. $55 trillion threatened to drain from the system in a matter of hours. The flow of credit had stopped. A localized decline in housing had evolved into a systemic breakdown that threatened the solvency of the entire global economy. The consequences quickly escaped Wall Street. The credit freeze halted international trade and slashed exports, devastating manufacturing workers from Detroit to rural China as the real economy ground to a halt. The government's drastic rescue measure, TARP, injected $700 billion into the largest banks to force credit markets open. But the mandate had significant omissions. It required no relief for underwater homeowners and no criminal accountability for the system's architects. Taxpayer money restored liquidity to the institutions, but the toxicity was simply absorbed onto their balance sheets. The rules of capitalism were suspended to ensure the survival of the largest banks. The damage report reveals a stark contrast. Wall Street returned to record-high bonuses, while Main Street faced 10 million foreclosures. This wealth destruction was exceptionally severe for marginalized groups. Median white household wealth fell 23%, while Black and Latino wealth plummeted by 60%. Watching public funds recapitalize the exact same institutions that caused the crisis, while everyday citizens lost their livelihoods, pushed society to a breaking point. Despite new legislation, the complex shadow banking models and derivative markets remained intact. Furthermore, the surviving megabanks simply absorbed the failing ones, growing even larger and permanently too big to fail. The immediate panic was contained, but the systemic flaws were largely preserved. The machine was stabilized, but the blueprint was never rewritten, locking in lasting economic inequality and fueling an era of intense political polarization.
Coiled spring strategy. Profit from volatility before the market breaks.